Chairman Bernanke, Vice Chairman Dudley, and members of the Federal Open Market Committee, we appreciate the opportunity to discuss the economic outlook and make monetary policy recommendations. In this staff meeting, we will begin by, first, addressing the current state and direction of the U.S. economy. Second, we will highlight those key factors which appear to be restraining the recovery. And third and finally, we will propose and justify that the FOMC adopt a price-level target consistent with 2% inflation indexed to the year 2008 in order to achieve its objectives of maximum sustainable employment and price stability.
With respect to the dual mandate, it is clear that while prices have thus far remained stable, unemployment is well above desirable levels. Unemployment surged during the recession and has remained high primarily because of sluggishness throughout the economy. Third quarter GDP estimates of only 2% annualized are no higher than the average rate of expansion since the end of the recession. The pace of this recovery overall is much slower than that of most US recoveries in the last half century. The question then becomes, why is the US economy not rebounding, and what is weighing on economic growth?
We believe that the sluggishness in the economy stems from three key factors. 1, impediments to consumption. 2, business uncertainty about aggregate demand. And 3, weakness in the housing market.
We begin our discussion with consumption. In the last year, consumer spending has decelerated because of high unemployment, flat wages, and declining home equity. Consumers' efforts to repair their weak balance sheets have also weighed on spending. While it's true that households have made some progress in deleveraging since the recession, they still face elevated debt burdens and tight credit conditions. Rather than spend on goods and services, consumers are instead choosing to pay down long-standing debt.
Although the personal savings rate has dropped to 3.5%, we view this drop not as an indication of strengthening consumption, but rather as a consequence of falling real wages. Further declines in the savings rate are not sustainable. Moreover, consumer confidence in past months has fallen to close to its lowest level since March 2009. This supports our analysis that consumption will remain weak in the near term.
Businesses are similarly pessimistic about future consumption, which explains why they have been so reluctant to invest. Business uncertainty is further compounded by the risk and volatility generated from the European sovereign debt crisis. U.S. banks have $640 billion of exposure to risky European debt. Moreover, businesses that do desire to invest often have difficulty accessing credit, and this is confirmed by the most recent Senior Loan Officer Survey.
All of these considerations weigh in investment. And when businesses do invest, they invest in capital rather than labor. This explains why initial jobless claims remain at elevated levels and why surveys of firms indicate that hiring plans have been limited. Investment has largely been contained to software and equipment. However, now that productivity seems to be peaking, future investment will likely be in labor, and this suggests that expansionary policy can have an appreciable effect on unemployment.
The situation is particularly pressing because cyclical problems may be turning into structural ones. Long-term unemployment now constitutes 42.4% of overall unemployment, while the average unemployment duration has increased to 39.4 weeks. Recent studies even suggest evidence of hysteresis. Those unemployed longest see their skills atrophy. Overall, the Survey of Professional Forecasters estimates that structural unemployment has increased and now lies around 6%, which gives considerable room for the Federal Reserve to take action.
The final factor dragging down the real economy is the weak housing market. Prices remain 30% below pre-recession levels, which has generated a vast negative wealth effect and dampened consumption. Inventories of existing homes stand at 8 months, which means that prices are likely to remain low and new construction subdued. New home sales are close to their lowest level in 48 years, which helps explain why investment as a component of GDP has lingered 16% below pre-recession levels.
So, in short, the slow pace of growth of the US economy has and will continue to do little to boost employment. The question we must answer is whether there is room and reason for the Federal Reserve to act. Given the high cyclic unemployment and the grave risk of hysteresis amongst the long-term unemployed, we think it urgent that aggressive policy measures, namely price-level targeting, be taken.
Clearly, the ultimate goal of our proposal is to reduce unemployment in the context of price stability. Now, we see two major ways of achieving this. The first is that we should increase inflation expectations in the medium term in order to boost inflation now. This would result in lower real interest rates and also accelerate the consumer deleveraging process. Secondly, we should shore up the housing market, as it has been a significant drag on the U.S. economy.
Given that we hope to create inflation, we should look at where inflation is now. So core PCE lies at 1.7% year over year, and current inflation expectations, as measured by surveys and by the 5-year tip spread, indicate that the outlook for inflation in the medium term remains subdued at about 1.5%.
Increasing inflation today is beneficial through two primary channels. The first is that with nominal interest rates close to the zero lower bound, higher inflation today will result in a reduction of real interest rates, in many cases to negative rates. This will stimulate businesses to spend some of their large cash holdings and also banks to lend out some of their $1.5 trillion of excess reserves. This will help reduce unemployment by accelerating the pace of business investment.
Second, higher inflation stimulates consumption by easing the debt burden on households. As we discussed earlier, consumer deleveraging has continued to weigh on spending since the recession. Reinhardt and Rogoff cite this as a primary reason for the slow recovery. Higher inflation addresses this by reducing the real value of fixed debt. This increases the pace with which consumers repair their balance sheets, which boosts consumption and also signals to businesses that now is a good time to invest.
Now that we've discussed some of the benefits of higher inflation, now we'll move into specific policy proposals through which we can achieve this higher level of inflation. We would recommend that the FOMC achieve higher short-term inflation while reducing variability of long-term inflation expectations by instituting a price level target consistent with 2% inflation.
The specific mechanics of targeting a path for the price level are as follows. The last time core PCE grew at the ideal rate of 2% was October of 2008. And so we use this date as the index for drawing a path for the price level consistent with 2% growth. It's clear from the graph that the price level has dropped appreciably below the desired path. Targeting a specific path for the price level allows the Fed to recoup the past period of disinflation with higher inflation in the short term. While there are multiple routes which return the price level to the desired path, we recommend that core PCE expand at a rate of 2.8% for the next 2 years and 2% thereafter. This raises inflation to a level high enough to be stimulative, but not so high as to undo the work of over 30 years of disciplined central banking. In order to achieve necessary inflation, the FOMC should engage in the immediate purchase of $600 billion of assets, $300 billion in treasuries, and $300 billion in mortgage-backed securities. If these purchases are insufficient in achieving the target, the committee should engage in additional asset purchase as necessary. Finally, the committee should recommend to the Board of Governors a reduction in the interest rate on excess reserves from 25 to 10 basis points.
We consider price level targeting to be the Fed's best policy tool for maintaining price stability in the long run for two reasons. First of all, price stability anchors inflation expectations better than any other communication strategy. While inflation targeting ignores past failures and behaves like a random walk, price level targeting adjusts for base drift. This allows both individuals and businesses to more precisely predict inflation over long periods of time, and it increases and improves economic decision-making.
The second advantage of price level targeting is that it serves as an automatic stabilizer for inflation expectations. And this is the argument made by Gaspar, Smets, and Vestin at the European Central Bank. Under price level targeting, if the U.S. economy experiences a disinflationary shock, the Federal Reserve would react with expansionary monetary policy, would generate higher than 2% inflation to make up for lower than expected prices. It's the Federal Reserve's commitment to this policy that would help moderate the impact of the disinflationary shock, and it would therefore contribute to greater long-term macroeconomic stability.
So how exactly would we go about achieving our desired level of inflation? We expect that the announcement of our proposal alone will markedly increase inflation expectations. Research done by Spordone and others at the New York Fed provides evidence for this so-called announcement effect. They conclude that in 2004, market perceptions about the Fed's intentions were responsible for increasing inflation expectations. This resulted in the rising core PCE to 2.5%. Now, we believe that an explicit communication strategy can replicate these effects. And specifically, a commitment to higher inflation now should increase inflation expectations and allow the Fed to hit its target.
Right. But to the extent that the announcement effect is insufficient in achieving necessary inflation, we believe that asset purchases can generate the necessary inflation. So academic estimates of the $600 billion of gradual asset purchases made during QE2 range from 10 to 50 basis points. Our proposal features the same quantity divided between treasuries and MBS, but it is front-loaded so that the purchases are made immediately and the inflationary effect is magnified. Therefore, even without the announcement effect, asset purchases can generate a substantial amount of inflation. Taken all together, the initial purchases, the announcement effect, the initial purchases, and the commitment to future purchases should enable the Fed to achieve its price level target.
But asset purchases are useful not only for their inflationary effect, they also positively impact the real economy. John Williams at the San Francisco Fed conducted a literature review, and he found that $600 billion in asset purchases consistently lowered long-term treasury yields 10 to 20 basis points. A decrease in long-term treasury yields then translates to lower interest rates across the board as individuals shift from treasuries to alternative assets like corporate bonds. And this is known as the portfolio balance effect. Faced with lower borrowing costs, businesses have a greater incentive to invest. And lower interest rates help to drive up equity prices, which generates greater consumer demand through a wealth effect. Finally, lower interest rates induces dollar depreciation, which boosts gross exports. Buer and Olivet at the Boston Fed estimate the effect of quantitative easing on unemployment. They trace a decrease in long-term treasury yields to an increase in GDP, and then conclude that QE2 generated 700,000 jobs over the course of 2 years. Future asset purchases have the potential to generate hundreds of thousands of more jobs.
The purchase of $300 billion of mortgage-backed securities, in addition to propping up inflation expectations, can also help mitigate some of the weakness in the housing market. Research conducted by Hancock and Passmore here at the Board of Governors analyzed MBS purchases from QE1 and found that through reduction of MBS yields, these were able to reduce mortgage rates by 100 to 150 basis points. We believe that our policy could replicate some portion of these decreases, which would help the real economy in two major ways. First, it would increase purchases of homes by decreasing the cost of borrowing, and second, it would induce consumption amongst those who choose to refinance.
A final expansionary measure that the FOMC can take is to recommend to the Board of Governors a reduction in the interest paid on excess reserves. Now, we would suggest a reduction of the rate from 25 basis points to 10 basis points in order to stimulate banks to lend out some of their large quantities of excess reserves. We would not recommend an even further reduction of the rate or the institution of a penalty rate in order to avoid some of the risks posed to short-term money markets that were outlined by Chairman Bernanke in his 2010 Jackson Hole address.
Bernanke's argument is that a policy of zero or negative interest on excess reserves would lower short-term treasury yields and other high-grade asset yields as banks shift their assets away from reserves. Money market mutual funds rely on these high-grade assets for returns. And the danger is these funds will take on excessive risk in order to maintain positive returns after fees. This poses a serious threat to financial stability because money market funds are considered safe. However, a policy of interest on excess reserves at 10 basis points avoids this consideration because banks have no incentive to purchase assets that yield less than their reserves. This means that money market funds can continue to make positive returns without taking on excessive risk. In essence, our policy generates some potential upside in terms of lending with little or no risk.
To conclude, let us return to the key points of our presentation. We began by discussing impediments to consumption, pessimism and uncertainty by businesses, and weakness in the housing market. Now, to address these factors and to reduce the high level of unemployment, we suggest that the FOMC adopt a price level target consistent with 2% inflation indexed to the year 2008. Our primary argument is that while decreasing variability of long-term inflation expectations, we can also boost inflation now, which will result in a reduction of real interest rates, which will help the consumer deleveraging process and also stimulate banks to lend out their large quantities of excess reserves and businesses to spend some of their large cash holdings. To supplement the announcement effect, we recommend an immediate front-loaded purchase of $600 billion in assets, that is, $300 billion in mortgage-backed securities, and $300 billion in treasuries. The Fed should also commit to additional asset purchase as necessary in order to achieve our price level target. Finally, the FOMC should recommend to the Board of Governors a reduction of the interest paid on excess reserves from 25 basis points down to 10 basis points in order to stimulate banks to lend out their excess reserves, which will then help us further achieve our price level target. Thank you very much for taking the time to listen to us this morning. We're now open to questions.
Thank you very much. Well done.
I do have a clarification. It might have been something that I just missed in trying to keep up with you guys. How did you pick the starting point for your price level path?
So there are a bunch of reasons why we choose October of 2008. The specific reason we mention in the proposal is that that's the last time that core PCE was at 2%. But there are also a few other reasons as well. The first is that approximates the time that the Federal Reserve ran out of conventional tools of monetary policy because it hit the zero lower bound on December 18th. And then one additional reason is that it seems to be a very convenient target for achieving both inflation in the short term, which is beneficial, and also long-term price stability. So in terms of choosing a starting point that is ideal for all the economic outcomes we're looking for, we think that October of 2008 is best.
Okay, great, thank you. I want to ask you a little bit more about unconventional policy. In a sense, your presentation was entirely about unconventional policy, and you went on at length about your particular choice for unconventional policy. What I'd like to ask you to do is to give me as full a description as you can of the complete set of tools available to the Fed, to a central bank, if it wants to add accommodation or stimulus in an environment where its interest rate policy tool is at or near its lower bound, and some discussion then of, among that set of tools, the mechanisms through which they are intended to work on the economy, and the benefits and drawbacks of alternatives.
So I can start with the first tool that probably has been the most controversial that the Fed has engaged in, and that is quantitative easing. And this is, it started in 2009 when the Fed announced a $1.25 trillion purchase of MBS, also agency debt, and also in August of 2010, there was an announcement of QE2, which was $600 billion of Treasury purchases. So in reference to the mechanism through which this acts, we mentioned in our presentation that quantitative easing, by lowering the yields on Treasury securities through the portfolio balance effect, this reduces the yield on a wide variety of asset classes. This, in turn, stimulates investment because corporate bond yields are lower. It induces more consumption because of a greater wealth effect for higher equity prices. And finally, by inducing dollar depreciation, this is intended to boost gross exports.
Let me directly follow up on what James said by adding some numbers based in the literature as to what the effect would be by asset purchase. So there was a paper by Wright at Hopkins which argues that a 14 basis point drop in the yields of long-term treasuries translates into a 50 basis point increase in asset prices. And secondly, this was also corroborated by a paper by Bernanke and Kenneth Kuttner, who is at Williams College, indicating that a 25 basis point drop in long-term treasury yields translates into a 100 basis point increase in asset prices.
I'll move on to talk briefly about another mechanism that the Federal Reserve can use. And this is something that exists throughout all times but has become particularly important now, and that's the use of communication strategies. So this started recently. The Federal Reserve started changing the communication it uses. So it decided to keep interest rates exceptionally low through 2013, which is a deviation from previous decisions. And the goal there is to indicate a long-term commitment to keeping interest rates low and to being accommodative in the economy in general. Now, our policy itself sort of piggybacks on that with the use of a price level target, because we say that we are going to keep interest rates lower and continue to purchase treasuries and continue to purchase alternative assets until we hit the price level target. Now, there are some important reasons why the management of expectations can be crucial, and this is an argument that's been made specifically by Michael Woodford. The argument is that in a current situation like exists today, where money and treasuries become near perfect substitutes, what's been approximated as a potential liquidity trap situation, it is necessary for the Federal Reserve to commit long-term to keeping interest rates low. In fact, longer than when we think the economy is going to get better, in order to make sure that, in fact, agents in the economy react. And this is why, for example, we saw that in Japan there was a substantial increase in the monetary base, up to 67%, and yet we saw no inflation, because the belief was that that money would be taken out of the economy as soon as the economy rebounded. It's a long-term commitment that's necessary to get the effects we want.
Let me add two more short things. I suppose our most recent policy action was Operation Twist. So this is the commitment to shift $400 billion of short-term securities to longer-term securities in an effort to flatten out the yield curve. So also this doesn't balloon the size of the balance sheet as, say, a policy like quantitative easing does. moving back to earlier stages of the crisis, we saw the rolling out of several emergency liquidity facilities, so under the Fed's power to act in unusual and exigent circumstances. So, for example, we saw the term auction facility, we saw maiden lane extensions, we saw the primary dealer credit facility, it's affectionately referred to as this alphabet soup of facilities. So we saw a lot of those, and again, the purpose for those was, we saw the spreads in the short-term credit markets like the LIBOR iOS swap, the TED spread soar, and these are things which have actually been a little bit elevated recently. So the TED spread's at 52 now, which is higher than sort of conventional levels. So these are things which may need to be used, say, if European situation turns sour.
And let me also add two more quick things. The Fed had started to use IOERs, interest and excess reserves, as a policy tool, and we can see that both in contractionary measures as in terms of reduction of IOER in the way expansionary we want to use it, or contractionary as well. And lastly, one policy measure that is not talked about as often but nonetheless very important. The crisis has taught us one thing, which is that regulatory intervention is also quite important, and we see that traditional monetary policy is often too blunt a tool to achieve that. So Blanchard talked about this in an IMF working paper, and we see that microprudential policy can be quite effective to target more specific goals in the regulatory framework of the Fed. So we see cyclical policies such as loan-to-value ratios for house prices. We see capital and liquidity ratios, or requirements on the leverage ratios that banks hold. And those things can be used and made use of to target more specifically regulatory goals.
Thank you.
Okay, you've chosen price level targeting and made quite a case for it. Can you tell me a little bit about, did you consider inflation targeting, the dual mandate, target for unemployment, for nominal GDP, and why did you choose price level targeting over any other specific targeting, and what would be the disadvantages to using price level targeting?
Let me begin with one argument specifically, first based on what we talked about in the presentation about why price level targeting would be beneficial and more useful than, say, inflation targeting. So price level targeting will allow for a long-term commitment to the price level and doesn't have the element of a random walk that we might see in inflation targeting, because in price level targeting, if you have disinflation one year, you recoup that with reinflation the next year, which leads to long-term stability in inflation expectations. And actually, empirically, we see this as well. So there was a paper by Kahn at the Kansas City Fed, which essentially argues that if we look at a couple different nations which have inflation targeting, that would be the ECB from 1999 to 2006, Sweden, and the Central Bank of Canada. All of these had inflation targeting, but they weren't actually able to achieve their inflation target in the long run because of essentially base drift. And price level targeting adjusts for base drift, which is one primary benefit of price level targeting over inflation targeting.
So let me add the other very crucial side to our argument. By the institution of price level targeting, we seek to institute expectational adjustment and thus automatic stabilizers in the economy. We think that price level targeting can actively, by creating expectations among agents in the economy, act as automatic stabilizers. So if we have a price shock, if we have aggregate demand shock, expectations will counteract that. And by extension, and this is an argument that we didn't specifically make in the presentation, but that has been proposed by Roberto Billy at the Kansas City Fed, by the same mechanism, we also have a adjustment mechanism for nominal interest rates. And this allows us to actually more effectively avoid the zero lower bound, which is probably also very important thing about price level.
There's also a couple, So there's also a couple of reasons why we chose price level targeting as opposed to nominal GDP targeting. The main disadvantage that we see with nominal GDP targeting is that it's difficult to estimate growth in the long run, and this is something that's required with NGDP targeting. So, for example, from 1945 to the mid-1970s, the average growth rate was around 3.3%. Whereas the average growth rate from 1970s to today was around 2.7%. So the danger is that if we underestimate growth, we'll have to compensate with unnecessary contractionary policy, whereas if we overestimate growth, we'll have to compensate with unnecessary expansionary policy. And this is problematic.
A second reason in favor of price level target over nominal GDP targeting is an argument based on expectation management. That is, a nominal GDP target really encodes two growth rates. One is a real rate of growth for the economy, and one is an inflation target. So agents in the economy, in order to set their inflation expectations, have to back out this inflation expectation from this sort of composite of two numbers, which leads to greater variability across agents, which in the long term has its economic costs, which is not there in the price level target we hand them.
I'll add one final objection to a nominal GDP target that we think makes price level targeting preferable, and this is a problem of credibility. So the advantage of price level targeting is that it continues the Federal Reserve's previous concern with paying attention mainly to price level and keeping it around 2%, so the comfort zone for inflation has been between 1.5 and 2%. And so we believe the Federal Reserve has the credibility to hit that price level target. And GDP targeting, however, represents a paradigm shift in what the Federal Reserve focuses on to also include rates of growth. And given the large gap that exists in the NGDP that we would want to get and the NGDP we currently have, we believe that there's a risk of credibility the Federal Reserve would not be able to hit its NGDP target.
So you also wanted
Very
to
quickly, if you would, what would be the disadvantages of
Right, I was just gonna come to that. So there are a number of disadvantages that we considered. One of them being that some economists make the argument that price level targeting actually comes at the expense of increased output variability. We see that prices in the economy remain sticky, and in order to adjust, the Fed would have to expand or enlarge the output gap at some points. However, we see this not as a problem per se, because we believe more strongly in this adjustment mechanism that we have described in the presentation, and that Gaspar Smets and Weston make a case for in their paper at the ECB. And lastly, Svensson, in his seminal paper in 1999, actually compared inflation targeting with price level targeting and came to the conclusion that price level targeting is able to reduce inflation variability with the same amount, with equal output variability. And that's what we believe is actually the case here. And then one other point, very quick note, is that some economists point out price level targeting might be more difficult to communicate, but as Gaspar Smets and Weston make very clear in their paper, it is actually more easy when you consider that you simply have to communicate the path of the price level as opposed to inflation numbers, or in the case of NGDP, where you have to back out the inflation numbers. So we believe it is actually more easy to communicate to the public.
Thank you.
Another problem we would say with price level targeting.
We're going to move on to the next question. So you mentioned, I think briefly in the discussion, the Europe situation. I'd like to invite you to expand on this. Specifically, I'd like you to tackle it in two separate sections. First of all, talk about what you see as the nature of the crisis in Europe. And secondly, what the potential implications of this are for the U.S.
So let me start by briefly describing the euro situation. What we've seen is after the institution of the euro, countries such as Greece and Spain have gained access to cheaper credit. And thus, we saw a distortion in the current account balances, and that's actually the argument that's been made. We see a strong correlation between current account deficits and the debt and the problems that countries face currently. So we saw that capital funds drew into those countries, and that came at the expense of productivity improvements. Now, what we saw after the crisis is that confidence, mainly on the investors' side, fell rapidly, and since these countries faced very high levels of debt, that became problematic. The most recent rescue package featured a 50% voluntary write-down on the sides of the banks, as well as an increase in the EFSF to about 1 trillion, and a mandatory recapitalization of banks that amounted to 106 billion. And the question is whether that is actually going to help or not. Now, in respect to the U.S., how that's going to affect the U.S., Jörg Krämer from the German Commerzbank actually came out and said that if Spain and Italy become impacted by the crisis, the EFSF will not be able to help them out, and that's actually what we're seeing. And the crisis would, in the case of an escalation, impact the U.S. in two major ways. One would be a shortfall in aggregate demand on a global level if the global economy dives back into recession. The second would be spillover of the banking crisis, and we do see interbank lending freeze up in the Eurozone. We do see huge amounts of debt accumulated on banks' balance sheets, and that's the main problem.
So let me elaborate a little bit more on the sort of effects that we could see in the financial markets or that we've already seen. So we've seen volatility increase. The VIX index is now above 30, and in the beginning of the year. Earlier, it was around 15. We have $640 billion of direct exposure to Portugal, Ireland, Italy, Germany, and Spain, as we mentioned in the presentation. Sorry, Greece. Greece and Spain. More recently, we've seen the 10-year Treasury decline to 1.97 after the worst German bond auction in 35 years. So we've seen, automatic effects, and I suppose Andreas mentioned counterparty risk, or spreads have already started to widen. So.